China just pumped over $1 trillion into its economy. Why? Because things aren't looking good. The property market is crashing, people aren't spending, and companies aren't borrowing. To fix this, China's central bank has launched a series of big moves, cutting interest rates, lowering how much cash banks need to hold, and injecting a massive amount of money into the system.
第一项呢是降低存款准备金率和政策利率。
So, what does all this mean? Is it going to save the economy? Would it make a difference for everyday people, businesses, and the global market?
近期将下调存款准备金率0.5个百分点。
And more importantly, would it be enough to hit China's target of 5% growth this year? Let's dive into what's happening and see if China's bold stimulus efforts can really turn things around. Key stimulus measures by the PBOC. China's central bank, the People's Bank of China, PBOC, isn't holding back. To boost the economy, it's rolling out several key measures. First, they've cut the 7-day reverse repo rate twice since July. This might sound technical, but basically, it's how the PBOC lowers borrowing costs for banks, making it cheaper for them to lend money. The idea is that cheaper loans mean more people and businesses will borrow and spend, putting money back into the economy. Another major move is reducing the reserve requirement ratio, RRR, for banks. This is the amount of money banks need to keep on hand and not lend out. By cutting the RRR, banks can now lend more money, which is expected to inject about $1 trillion, around 142 billion USD, into the financial system. That's a lot of cash suddenly available to boost spending. On top of that, they've hinted at even more cuts and monetary stimulus in the future if the situation doesn't improve. So, while these moves are big, the PBOC is prepared to do even more if needed. But the big question is, will these measures be enough to solve China's deep economic problems? That's what many are waiting to see.
Headline figure when it came to fiscal spending. However, others saw the briefing more positively. For example, Bank of America called it a policy pivoting point. And of course, there's still anticipation that we could see some specifics down the road in the coming week.
Impact on stock markets and property market. The impact of these stimulus measures has been immediately felt in the stock markets. As soon as the PBOC announced these moves, Chinese stocks jumped. In Hong Kong, the Hang Seng China Enterprises Index surged by over 3%, while the CSI 300 in mainland China went up about 1.5%.
You're going to notice something jump out, maybe. We got 4% moves in not only Hong Kong, but also China. Let me show you their benchmark, the CSI 300. This is what happened today. They announced the stimulus measures, took a minute to take off. Here you go. There's a lunch hour, and boom, right after the lunch hour, more gains, and then into the close, up 4%. That is the best day for the index in 4 years.
Investors are hopeful that the flood of new money and liquidity will turn things around, at least for the stock market. However, the property market is still a big problem. Despite earlier attempts by the government to save the housing sector, prices continue to drop, and many homeowners have lost trillions in household wealth. The new measures include some support for mortgage holders, like lowering rates for new buyers, but there's still low confidence in the market.
二是降低存量房贷利率和统一房贷再低首付比例，引导商业银行将存量房贷利率降至新发放贷款利率的附近。
People are hesitant to buy, and the falling knife of property prices is making it hard for the housing market to recover quickly. Monetary versus fiscal stimulus. Is it enough? Monetary stimulus, like cutting interest rates and the RRR, is a powerful tool, but it's not always enough on its own. While it makes borrowing cheaper and puts more money into the economy, it doesn't directly tackle the real reasons why people aren't spending or companies aren't investing. That's where fiscal stimulus comes in, which means the government directly spending money, not just encouraging borrowing. Experts are divided on whether China's current stimulus blitz will truly be enough to lift the economy.
Yeah, that's right. This is the broadest push so far year to date by authorities and what the markets and many economists, analysts have been calling for, and that is broader policy support. You can call it a bazooka or not because we have to see how well this is targeted, but it is a very welcome move.
While some believe these moves will help China hit its 5% growth target, others argue that without stronger fiscal measures, the effects might be limited.
So now they're hoping with about 3 months left in the year and still with that growth target of around 5% GDP growth still in the sights, this will help push authorities past that goal of GDP growth of around 5%.
The PBOC's actions are focused on boosting liquidity, but there's still hesitation among companies and consumers.
We have stocks on the rise in Hong Kong and in China on these moves that address some real issues. Obviously, this injects a lot of liquidity, these moves by the PBOC and the two other finance officials, including the securities regulator, on a very rare stage today.
People are saving more because they're worried about the future, and businesses aren't eager to borrow, especially with deflation and a struggling property market. Many are also looking for more government spending, especially targeted at households. There's talk of possible cash transfers to families and debt relief for local governments. If this happens, it could provide a bigger boost to consumption, which is currently weak. Right now, China's economy needs people to feel confident enough to spend, but that's hard to achieve with just monetary policy alone. The balance between monetary and fiscal measures will be key to whether this stimulus blitz really works. Challenges facing China's economy. Despite all these stimulus efforts, China's economy is still facing some tough challenges. The first big issue is that people just aren't spending enough. Many Chinese consumers are more focused on saving money because they're worried about the future, especially when it comes to jobs. Even though interest rates are lower, it's not enough to make people feel safe about spending big. Another challenge is the real estate market. Housing prices are dropping, and many of the big property developers are in trouble. Real estate plays a huge role in China's economy, and when it's struggling, the whole economy feels the impact. People are seeing the value of their homes go down, which makes them spend even less because they don't feel as wealthy. Plus, businesses are also holding back on investments because they're unsure about the future. Finally, there's China's aging population. The number of young, working people is shrinking, while the older population is growing.
Now, China's leaders are trying to find ways to battle what many economists have described as a demographic, ticking time bomb. The country is aging and shrinking. 1 in 5 people are over the age of 60, which is the largest elderly population in the world.
This makes it harder for the economy to grow in the long run, since fewer workers mean less production and lower spending. If these problems continue, the stimulus efforts might only help in the short term without fixing the deeper issues. Impact on global markets. The effects of China's economic struggles are being felt around the world. One big impact is that China is buying fewer goods from other countries.
China, once the engine of global economic growth, is now losing its steam. Its economic slowdown is sending shockwaves around the world.
This is a problem for countries that rely on China as a major customer, like Australia and Brazil, who export things like minerals and raw materials.
As the world's largest importer, China's decreased demand for goods is affecting countries from Australia to Europe. This slowdown is particularly impacting commodities like iron ore, crude oil, and luxury goods.
With China slowing down, these economies are taking a hit too. At the same time, Chinese companies are increasing their exports of cheap goods to other countries. With fewer people buying at home, they're looking to sell more abroad. This is leading to a flood of low-cost Chinese products in global markets, which could lead to disinflation. Disinflation means prices aren't rising as quickly as expected. And while that sounds good for shoppers, it can actually hurt economies trying to recover from inflation. Central banks around the world are paying close attention. If China keeps sending cheap goods, it could mess with their efforts to keep inflation under control. It's a complicated situation where China's problems could ripple out and affect countries that trade with it. What could change consumer sentiment in China? How can we get Chinese consumers to start spending again? Right now, people in China are being pretty careful with their money. A big part of what could change this is a rise in confidence. If people feel like their jobs are secure and their incomes are stable, they'll be more willing to spend. But for that to happen, the economy has to show more signs of recovery. That includes the housing market stabilizing and wages starting to grow again. Another thing that might help is if the government steps in with more direct support. They could offer things like cash payments or subsidies to encourage people to spend. Lower interest rates can only do so much. What consumers really need is to feel like they're in a good place financially, and that means stronger job security and economic growth. Without those, it's hard to see how people will change their spending habits anytime soon. Long-term outlook for China's growth. In the long run, China's growth will depend on how well it handles its current problems. Stimulus measures can help in the short term, but real, lasting growth needs deeper changes. For one, China needs to shift its economy from relying so heavily on exports and real estate. Instead, it should focus more on building up domestic consumption and high-tech industries. This would make the economy more balanced and less dependent on external factors. Another key area for long-term growth is innovation. China has already made big steps in areas like tech and green energy, but it needs to keep pushing forward. The country's aging population will also play a role in how much it can grow in the future. With fewer young workers and more older people, finding ways to stay productive and innovative will be crucial. If China can tackle these issues, its economy could still grow steadily, even if it's at a slower pace than in the past. So, will this stimulus blitz work? It's hard to say for sure. In the short term, the measures might help boost the economy and give some relief to struggling sectors like real estate. Lowering interest rates and encouraging spending could help with that. But the bigger, structural problems, like the aging population, slow consumer spending, and dependence on real estate, won't be solved overnight. The government needs to take bigger steps to address these deeper issues, or the effects of the stimulus might only be temporary. For now, it's a waiting game. The world is watching to see if China's stimulus efforts will be enough to stabilize its economy and keep it growing. Only time will tell if this blitz can really make a lasting difference. If you found this breakdown helpful, be sure to give us a like. Don't forget to subscribe so you can stay up to date on all things happening in the global economy. We'll be here to guide you through the ups and downs with simple, easy to understand explanations. Stay tuned for more.